We're speaking today with the executive chairman of one of the largest gold miners in the world, Yamana Gold. Peter Marrone is back to give us an update on his company, the industry, and his outlook on the metals and mining sector. Peter, welcome back to the show. It's been a few months since we spoke. Lots to talk about, lots to update the audience with. Welcome.
I'm happy to be here, and thank you for inviting me to your show.
Peter, let's start with the financials of 2020. Q4 results have come in, and you've had a very good year considering that COVID has been very difficult for the entire industry. So starting with your top line, your revenue has shrunk since 2019 from 1.6 billion down to 1.5 billion. But I've noticed, just doing a back in the envelope calculation myself, that your margins have improved. So in 2019, your gross margin was 51%. Now it's at 60%. Can you comment on this rather substantial margin improvement and how that was achieved in a COVID year?
Yes. So the best way to look at it is that the production platform of the company is roughly 1 million ounces gold equivalent, between 850,000 to 880,000 ounces of gold, and in the range of 10 million ounces of silver. On a gold equivalency basis, it's 1 million ounces. Last year, COVID-19 was new to everyone, and it was certainly new to some of the jurisdictions in which we were operating. You might remember that in Quebec, for a period of time, there was a view that there should be a suspension of operations until mining was considered an essential service and we could resume operations. So Canadian Malartic, for a period of several weeks to month, was not in operation last year. More heavily impacted was our effort at Cerro Moro in Argentina. And Cerro Moro, the Argentine government really was a provincial matter. Provincially, the different provinces of Argentina took the position that there should be a restriction on interprovincial travel, of course, supported by the national government. We deploy people at our operation at Cerro Moro that come from other provinces. 100% of our employees are nationals of Argentina, but a percentage in the range of 35%, some essential employees, came from other provinces of Argentina. With those restrictions, it caused some challenges in terms of scheduling, what we did with shifts, and then what we had to do in order to protect the health and safety of employees. I think everyone can respect that, is we had to ensure that we maintain quarantine procedures, not just the normal and usual ordinary course of what one does to protect against COVID, like personal protective equipment, but maintaining a quarantine procedure. And that has its own attendant impact then on how one schedules with 14-day shifts and things of that nature. It had an impact on our operation, and that impact continued for most of the year. In December, just to conclude the thought, in December, we were challenged by, not at our operation, but across the province of Santa Cruz, where the operation is, where most operations had actually been shut down completely. We were challenged because there was an outbreak. And the result of that outbreak was that we were asked by the government of Argentina and Santa Cruz if we would take the initiative, showing leadership by reducing our operations so that we can help in the effort to contain what was happening with COVID-19. And that had an impact overall on our operations. But overall, the production platform of the company is roughly 1 million ounces, and then 901,000 ounces last year reflects the fact that we were impacted by COVID-19. The actions that we took on margin were essentially to say, if we cannot get the revenue to be heftier than it's going to be, then what we will do is we'll take all the steps that are required to be taken to improve operational efficiency, to improve costs that allow us to be able to get to better margins. And that explains very much how we got those better margins despite the lower revenue.
Okay, I'm curious to learn just a little bit more about your cost of goods sold. So your costs were significantly lower in 2020 versus 2019, proportionally even to revenue, which is why your margins have increased. Was that mostly due to cuts in labor costs, or maybe cuts in production costs? Can you specify a little more?
Well, most of it was two factors. Most of it was the result not of cutting costs. Let's call it becoming more efficient.
Yeah.
How we can work more efficiently with people working at home, and how we can redeploy our human resources. Much of it was operational improvements. It wasn't the efficiencies in operations. How can we get more ounces coming from our existing operations? A lot of it dealt with Canadian Malartic and Canadian Malartic's ramp up, which was spectacular. Once it had been put on care and maintenance, when we ramped back up again, they did an excellent job of that ramp up. We had some concerns in terms of when we do planned shutdowns, because there are hundreds, if not thousands, of people at site. And how do we respect the protocols of distancing to deal with the COVID-19? And that went better than planned. And so that resulted in roughly, I call that operational efficiencies, leading to more ounces that led to better margins.
So Peter,
one more thing. Sorry, David, but one more thing, and that is that we need and are imposing a better discipline on ourselves dealing with Cerro Moro. Cerro Moro is coming in at a higher cost than our average cost. So interestingly, if we're producing less coming from Cerro Moro, it's actually in some respects contributing to better costs across the rest of the operations. It's a bit of an anomaly, but if you did the math, you could see why that would be. So we have to create that right balance with Cerro Moro, and you see that this year we're expecting to deliver higher quality ounces as a result of some of the things that we learned last year to make it more efficient.
That was my next question to you. Tie that in perfectly. The critical lessons you learned last year in regards to the operating efficiencies you talked about. What are some of these lessons regarding efficiencies that you will continue to apply into 2021 and beyond?
Well, in some respects, how would we make do with less? So not necessarily making do with less employees. That's not my point. But my point is making do with less employees for particular tasks. So redeployment of employees that allows us then to get more efficiencies. I think that's an important one that can't be overlooked. So I'm not an advocate of isn't it great that we can make do with less people? I'm an advocate of making sure that we've properly deployed resources, and our people are our best resource. And so that's part of the lesson learned last year that we're applying more effectively this year. And this year, because we're back to that production platform of 1 million ounces, that roughly 10 to 12% increase over the production last year, but normalizing to the production platform of the 5 producing mines, we get to a point then where our costs improve by comparison to last year. They're back to a level that is in the high 900s, low thousands, rather than where we were this year, which is close to about $1,080 per ounce. A solid $70 to $80 per ounce improvement in our overall costs.
Okay, Peter, I'd like to ask you a quick question about inflation, if I may. The economists I've spoken to have pretty much all agreed that inflation is coming in 2021. I'd like to ask an executive who actually has operations on the ground whether or not you've noticed inflation in terms of raw materials that you use, supplies, the cost of operating machinery, any of that. Have you seen increases in the costs of production on that front?
Well, we've guided costs this year already, and we've guided costs taking into account what we think is the inflation rate, what appears to be the inflation rate in the countries in which we operate. It is not very high levels of inflation in most countries. If we look at Chile, Brazil, and Canada, Argentina is a bit different. The inflation rate there is higher, but it also has a deflationary impact because it has a currency that's also weakened to our functional currency of US dollar. So net, that's a benefit. But if we look at the other countries, inflation rates are in the range of 2% to maybe 4%, not anything that's extreme. And so we're looking at that, and the conclusion that we've come to is that it is unlikely that will have an impact on our costs this year. And so what we've guided for this year is the same cost construct that existed in 2019, more or less. Yeah. The same range of costs as in 2019, taking inflation into account. So if we netted out the inflationary impact, we're actually coming in at better costs in 2021 than we were at 2019.
Okay. All right. Peter, I'd like to segue into your production and specific projects that you're working on right now. Before we do that, I have a more philosophical question for you. I was browsing YouTube the other day, and I stumbled upon a Harvard Business School case study. And the case was a minor like yourself, and the situation was all the students were role-playing pretty much your shoes, the CEO or the executive chairman. And the situation is an accident has occurred in a mine We don't know what the accident is. We know that there was a fatality. What is your initial response? Would you first shut down the mine, or would you keep it open and investigate further? And the students gave various responses. I found it very interesting. But what would an actual executive do?
Well, the starting point, I think, has to be the real-time reporting of what's taking place on the ground to local authorities, to the members of the community, to the members of the mining community, but the broader community, and of course, to executive offices. Because on that basis, we are then in a better position to be able to say, these are the actions to be taken. No one wants a fatality to occur or an accident to occur. But were something like that to occur, I think it's important to evaluate what is the broader impact to the operation before coming to conclusions on what to do with that operation. Normally, if something that severe happens, even if there's one significant accident, that may lead to a fatality, not more than that. We take the position that we're shutting down operations until we have conducted at least an initial investigation and brought local authorities in and local community representatives in to have a look-see at what's going on. And while corporate office then critically evaluates what we're doing. But I think what's important here is, and hopefully that Harvard Business Review study did this, is I think that what companies need to be doing is they need to be simulating things. If something happens, then what is the reaction? What do we do? And what is the approach taken with local community? What should the local community do? We do that at our operations. Jacobina is an excellent example of that. So God forbid if there's an accident, a tailings challenge as an example, we don't foresee that, but if that should occur, we simulate it. And we say, this is what the actions are. This is what you will hear. These are the response things that are important. These are the actions that you are required to take and the actions that we are required to take. Mm-hmm. And by simulating it, what it does is it takes the sting away. It takes the uncertainty away. And it also creates the opposite of that, which is the certainty of this is what we should be doing. And this company cares about the community. And so let's work cooperatively in making sure that we avoid some of these things. One more point that I think is important here, which is that many companies have a tendency of investigating accidents. What is a lead indicator is often not investigated. And the lead indicator is what was a potential accident that did not occur. And what are the lessons learned from that? Mm-hmm. So a near miss, an accident where someone could have been injured, a truck that rolls over and someone could have been injured but was not. What is the lesson learned from that? Or a truck that did not roll over but could have rolled over. What's the lesson learned from that? What that does is it creates a culture of health and safety. And I think that's critical to your question, which is what's the response of an executive team if, God forbid, something should happen?
Yeah, I think you should have been a guest lecturer at that lecture, Peter. I think that was a better response than any of the students of the Harvard Business class. But okay, just very quickly, in that situation, I'm just curious, how long typically would a mine stay shut down?
Again, it depends on the circumstance. It could be shut down anything from a day to several days to as much as several weeks, depending on the circumstances. If there were an accident involving someone in a pickup truck on a road, that is different than if there is an event that occurs in an underground operation where there is a rock burst that occurs. And so we look at it on a case-by-case basis, but we also have identified categories and what our actions should be by those identified categories.
Okay, perfect. Let's talk about production now. Can you give us some guidance on this year's production output and maybe tie that into some of the updates in your project? So the Malartic, Jacobina.
Yeah. So as I said a few moments ago, we expect that production platform to be about 1 million ounces gold equivalent, roughly 10 million ounces of silver, just a little over 10 million ounces of silver, and in the range of 850,000 ounces of gold. We produce a little bit of zinc at one of our mines, but that's really not very consequential. And that goes to a bit of a deferral of some of our costs. But that's the production platform that we expect out of the company. And on a mine-by-mine basis, and I should also mention that this is our first year in which we've given guidance mine by mine. We normally give 3 years of guidance in aggregate, but only 1 year of guidance mine by mine. This year, we've said we've got high conviction on the production platform of each of our 5 mines. And so we've given guidance on a mine by mine basis for the full 3 years of our guidance period. But we expect a production platform in the range of 350,000 ounces coming from Canadian Malartic. We expect a production platform of about 160,000 ounces from El Peñon, plus silver in addition to that. Gold equivalent Peñon is about 220,000 ounces. Jacobina's production platform is in the range of 175,000 ounces. Those are the largest of the components that get us to that million ounces of production. Mm-hmm. Rounding that would be Minera Florida in the range of 90 to 95,000 ounces, and Cerro Moro between gold and silver in the range of 130, 140,000 ounces.
Okay. Let's talk about a recent deal that Yamana has made, which is the acquisition of Monarch Gold. I think you spoke offline with me about this deal. It was recently announced, and the transaction has recently gone through. Can you first of all walk us through the impetus behind this deal, why you decided to purchase a deposit in the Abitibi region in Canada?
We'll start with residential address. And you mentioned Abitibi, you mentioned Quebec. Quebec is an excellent jurisdiction for mining. We have said that we want to increase our Canadian platform. And if we're going to increase our Canadian platform, then why not stick with bread and butter, what we know? We're already in Abitibi as a result of our investment and ownership of the Canadian Malartic mine. And so it was a natural for us to say that Abitibi is a region that we should be expanding our footprint. And because of that engagement in Abitibi, we also had the ability to be able to say, here's what we're seeing happening on the ground with various opportunities. I should mention that there are always personal elements to these things. And so on the personal side, our chief executive officer and our head of operations are both from Northern Quebec. And so they're very familiar with that. But much more than that, let's look at what's been happening in Northern Quebec, in many districts of the world, but in Northern Quebec in particular. Canadian Malartic ought not to have been in existence. No one assumed that there was this big porphyry type open pit opportunity that it has become the Canadian Malartic open pit operation. Equally, while there was in 2014 when we bought it, we recognized that there was an underground opportunity. No one could have anticipated that it would be more than 14 million ounces and continuing to grow. It's been a remarkable success. And again, these are mined districts of Canada, mined districts of the world. So it came to us as almost logical that there is more there if one looks at newer mining methods, if one looks at different geological interpretations. One would never have mined a couple of decades ago at 2.5 grams or 3 grams per ton underground. And today we're able to do that with bigger bulk tonnage. And that's what the Odyssey project at Canadian Malartic is all about. Wasamac represents one of those. But more interestingly, it represents one of those opportunities that had already gone through feasibility study. And there is often a tendency to be dismissive when a smaller company has completed a feasibility study. Well, we looked at that feasibility study and came to the conclusion that it was very well done. I would border that on exceptionally well done, and it's only 2 years old. So we looked at it and said, we can buy 1.8 million ounces of proven and probable reserves that are feasibility grade proven and probable reserves at a grade that is comparable or better than our Jacobina mine, comparable to what we have at Odyssey at Canadian Malartic, and we can do that comparatively inexpensively. And so it gave us an excellent opportunity to say, this is something that we should pursue and that we should purchase. Then you go from there and you say, well, given our experience with Malartic's underground, and what we're doing at Jacobina, how can we improve on that? And we've said between now and the third quarter of next year, we'll look at ways to optimize. We're confident that we'll be able to show those that optimize that production platform. But what it gives us is a production platform of between 150 and 180,000 ounces per year at all-in sustaining costs and cash costs that are below our average. And so it's an excellent opportunity. And we bought all of that at roughly $70 per reserve ounce and $40 per resource ounce. A very inexpensive purchase for us for an asset that we certainly have conviction will become another mine in the portfolio.
I'm sorry, how was that price determined? Was it a contract, or did you, when you usually make a deal, do you factor in the valuations using spot price of gold at the time, or is it a forward contract? How does that work, Peter?
So we looked at different gold prices to determine what the value should be. In this particular case, we said we run a model that looks at the feasibility study with how we would optimize it. And now we're checking the box on those optimization categories, but how we would optimize, update it, and improve it. And what does that deliver in terms of a net asset value? But we also looked at it on a per ounce of resource and per ounce of reserve basis, and what's consistent with market, and how can we negotiate an effective deal with the management of that company.
Yeah.
What presented a unique opportunity to us is that there were assets inside the company that appear to be good assets, but they're not advanced enough that it made sense for us to buy them. And so what we were able to do is we were able to say we can afford to pay a premium for this company. It's still less than $200 million of total purchase, literally a small tuck-in for us. But we also were able to deliver that premium with a SpinCo, which is a new company that is now freshly minted and listed on the Toronto Stock Exchange, with those assets that are not as advanced as Wasamac, but still can deliver some great value as a smaller exploration company. And that smaller exploration company is now public. We continue to have an ownership interest in it, and it is pursuing its own business plan.
Yeah, I'm just curious as to why you decided to pursue a deal when gold is at, well, near all-time highs. We saw gold breach all-time highs last summer. I'm just thinking, would you not wait for gold prices to taper down before you make an acquisition, or is that not part of your consideration?
Well, that's a really good question. So opportunities present themselves when they present themselves. And we have to look at it from the lens of what is the opportunity, what fit into the matrix, all factors, including what metal price assumptions can we make that are responsible and reasonable given what spot prices are, where they've been, and what the forward curve is showing, and where we can reasonably assume them to be. But we never look at spot and say we should be doing a deal based on spot prices. We're always discounting that spot price. And to proven and probable reserves, that's discounted to $1,250 per ounce, not the current level of $1,800 to $1,850. And even in an economic model, we're looking at a number that is closer to $1,500. Our Odyssey project has been evaluated on its economics based on $1,550, and we took a similar approach to the purchase of Wasamac. And then, David, what we do, not atypical, but we run sensitivities. What happens if gold price is lower? What happens if it's higher? And what we want to be able to do is to say that even if the gold price, we know what happens if gold price is higher, but if gold price is lower, are we still able to deliver a return on our investment? And that's critical. That's important. So the way that I look at it is that we're agnostic to gold price so long as we can deliver a return on investment that is a premium. We prefer a multiple to our cost of capital, so that we can say to our shareholders, we're delivering a robust return coming from this investment. And then we look at it and say, well, how are we intending to improve it that can improve that return? Deals are normally done, in my view, when gold price is very low or when gold price is very high. And it's unfortunate when they're done when gold price is very high. But I think the way to look at it is be less sensitive to gold price and more sensitive to what's the return based on a reasonable assumption to gold price that is below spot, and then a discount to that to determine that you can still deliver a return that is a significant premium above, perhaps even a multiple of your cost of capital.
It does seem interesting for me to observe when gold prices are high, there tends to usually be more exploration activity. And so there's more opportunities that present themselves, which ironically might be bad for a senior or a mid-tier, right? If the ones looking to make acquisitions. So it is kind of ironic that way, I've observed.
Well, one question that we should address perhaps is, and it's always a bit of a speculative game because there's so much emotion that's involved in the discussion, but it is difficult for me to predict where gold price will be on a short-term basis. And while I appreciate that there's an element of speculation in this discussion, it's very difficult to see that over the intermediate and longer term, directionally, gold price does not go to higher levels than where it is at today. And given the amount of monetary stimulus and fiscal stimulus that is in the world and likely going to continue to increase, the amount of government debt to GDP, I'm not suggesting that this is not tolerable, but what I am suggesting is this is the perfect storm for gold price to go to higher levels. Don't make a business plan based on gold price going to higher levels, but certainly from a personal perspective, I think that precious metals and gold in particular is going to, even if it corrects temporarily, is going to substantially higher levels. And silver is really an interesting one because we produce 10 million ounces of silver, and silver has begun to overperform gold. And in a more buoyant market for gold, silver will overperform, and that ratio of gold to silver decreases. And adding to which is that silver also has a very green component that we can't overlook. Mm-hmm. It is a principal component of solar panels. And so that is going to continue to drive, I think, the silver price.
Wouldn't that incentivize you to produce more silver relative to gold?
Well, we can only produce what we can produce inside the company with the assets that we have and with the sequencing of the assets. We don't have separate silver mines. We have two mines, Peñón and Cerro Moro, where we produce silver and gold.
Well, you could acquire silver mines, right? You could do
fair enough. Yeah. Fair enough. Well, the acquisition strategy should be based on many things, as I said. Yeah. Many things that go into a matrix. I'm sensitive to the following. I like the precious metals component of the company. I like the fact that dominantly we're a gold company. While I said that there's an emotion to gold price, equally, there's a bit of a steady state to it as well. Silver has a tendency of being more volatile, but we also have copper in the portfolio, interestingly, with our Mara project. And copper is sort of, if you looked at a spectrum, in the middle, we've got gold production, and that's a bit of a steady state, the bread and butter. At one end, we have more speculative with silver, and at the opposite end, we have considerable amounts of copper in our inventory that is more tried, tested, and true in terms of supply and demand. So I think it's an excellent portfolio.
Final question, Peter. Let's talk about this new strategy that you have that I haven't seen from miners of your size, which is a net zero emissions target by 2050. First of all, what is that exactly, and how do you plan to achieve it?
Well, there are two things, and I think this is important to say and to distinguish. We've established a long-term climate policy and approach. We have said aspirationally we expect to be at net zero carbon emissions by 2050. But perhaps more importantly, what we've also said is that it has to be science-based. It cannot be just aspirational. It has to be science-based, and we have to start from the ground up. And so initially, we're not assuming that we get to zero emissions by 2050. We're saying these are the steps that we will take to significantly reduce carbon emissions that get us close. And over the course of the next several years, we'll continue to refine the actions that we take in order to get us to zero emissions, net zero by 2050. So we've adopted a two degree science-based target. And that's important because we're confident that we can get to that level. And what we're doing is we're saying, presently, we're going to take the following actions. And this is a planning year on getting us there. We recognize that we can get to that level, but this is the planning year on how we get there. And then we'll deliver those milestones over the course of the year and into the next several years on how we get to that point. And as I said, it's from the ground up. So what we're saying is we're engaging our operations, we're engaging technical services, exploration, rather than on an ad hoc basis. How do we improve carbon emissions here and there? How do we reposition the platform of the company so that we're producing with zero emissions by 2050? Mm-hmm. David, may I say, we had a 13% reduction in carbon emissions last year. We had a 19% reduction the year before that to the previous year. Mm-hmm. The year before that, my apologies, a 26% reduction the year before. The year before that, we had a 19% increase because we had a new mine coming into operation, our Cerro Moro mine, and that increases overall carbon emissions. So what we're saying is going forward, planning a company as if we were planning it from scratch. You're building something new. How would we build it so that we are able to get to that, ultimately that aspirational goal of zero emissions by 2050? So a new mine is easy because we can say these are the steps that we will take that are going to deliver us with less carbon emissions. Electrification, using electric vehicles, how we deal with ventilation, how we deal with power supply, but how to retrofit our existing operations, what we have to do from a capital allocation point of view. These are the things the steps that one needs to take. So the important thing here is not aspirationally getting there by 2050, but what we've said more importantly, I think it should be very important to investors, is that we're going to outline the steps that we're going to take to get there. Rather than just saying, by the way, we're going to get there by 2050, we're going to show how we get there based on science targets.
Mm-hmm. Okay. Peter, I could talk to you for hours, but unfortunately we can't do that today. I'd like to follow up with you in a couple of months to talk more about your strategies, projects, and drill a little deeper, so to speak, on some of your acquisition studies, plans, and also the technologies behind mining. I think you have a wealth of information, so I'll be happy to catch up with you again. Thank you very much.
David, it will always be a pleasure. Thank you.
And thank you for watching Kitco News. I'm David Lin.